Aloha, ladies and gentlemen. We are continuing to look at selling cash secured put options on a variety of sector ETFs. We've got 12 different sector ETFs. We're just using these as examples. I personally don't own any of these ETFs. I'm not trying to take ownership of any of these ETFs. But just using these sector ETFs as examples of how to sell cash secured put options, potentially do the wheel strategy if we get assigned. If that is new to you and you want to learn a little more, check out ihavesuccess.com. There's a link in the description below this video. There's free stuff, there's paid stuff, and ultimately you will learn and theoretically how to sell cash secured put options on stocks you would be happy to own. If you're wondering why you should do something like that, right here is a link to 5 different reasons why you should do that in 2023 going forward. In fact, the first time I realized that if you have an internet connection, bank account, and you spend money at least once a year, that you have no legitimate reason not to be selling cash secured put options was all the way going back into 2014. It really dawned on me. It hit me like a ton of bricks. I realized, holy macaroni, there's no reason for a person with an internet connection, a bank account, and who spends money at least once a year, there's no reason not to do this in 2014. Guess what? 2014 with time turned into 2023. So here we are. Same thing is still true. And I believe probably the next 20 years it'll still be true. So let's actually get into looking at doing it. Right now, I have quantity 2 put options with a 30 strike, which means that if XLF by April 14th, if it's trading below $30, then I'm going to buy 200 shares, 100 times 2 contracts, at $30 each. So 100 shares times $30 per share equals 3,000 times 2 contracts, $6,000. I have over $6,000 in my account, so I have the money to cover this commitment, which makes this a cash secured put option. If I did how many ever contracts and I was on the hook for, let's say, $200,000 worth of XLF, then it would not be cash secured. It would be a naked. I'd be selling naked put options, which is a different risk profile. And so I am only advocating for you to do cash secured put options. So you have to be able to have enough intelligence and discipline to look at how much money you have in your account and figure out what strike price and how many contracts you're going to do to be below that number in your account, so that way you can fulfill your financial obligations. The part that makes this so powerful is that at the end of contract expiration, with this particular strategy, you're going to be in a situation where one of 2 things happen. One is the contract expires worthless, so you keep the premium. In this case, with these 2 contracts, I took in $8.50, right? $8.50. So in one scenario number 1 right here, I keep $8.50 and nothing else happens. In scenario number 2, I keep $8.50 and then $6,000 goes out of my account and purchases 200 shares of XLF. And it just happens to be that those 200 shares go into my asset column. This is the income column. This is the asset column. This is the liability column. And this is the expense column. So if this contract expires worthless, $8.50 flows into my income column. If the contract does not expire worthless, $8.50 flows into my income column, and 200 shares of the asset XLF flow into my asset column. Now, when I do this in real life, I'm making sure that these assets pay me a dividend. And every time they pay me a dividend, that dividend flows more money into my income column. And then I end up writing covered calls against them, and more money flows into my income column. That's why I love this strategy, because it expires worthless, I win. It doesn't expire worthless, I win. I like to be a winner, so that's the beauty of this. So that's what we have right now. I sold two different prices, right? I sold one contract. I asked for a minimum of 7 cents, and I sold one with a minimum of 10 cents. And I got filled on both for an average of 8.5 cents. So what we're going to do right now is I'm going to add on another. I'm going to add on another contract, which makes my obligation, adds another 3,000, right? Which, do I have that money? 9,000? Yep, I got it. But I want to pay attention to what I'm committing myself to. So we'll change this over to XLF. We see right here, I'm looking at I already have the position on the option chain with 9 days left to expiration. I see that the highest amount that this contract sold for today was 9 cents. Lowest was 3. A little less than 900 contracts change hands. So this is the ask is the buying column, bid is the selling column. You can know the difference because you're always going to sell. Of these two, you always sell for less. You buy for more, you sell for less. So if you can't remember bid and ask, you're going to sell the lower priced one. When I click that button, it turns red for sell. It should be -1. But let's say on accident, I click this. Boom. Oh no, now it pulled up green for buy +1. No problem. That's an easy fix. I just changed this right here to -1. Now I'm selling the contract. I'm going to bump this up to 9 cents. Keep it on limit order. That means that the limit I will sell, the minimum I'll sell this contract for is 9 cents. And I'm going to change this to good till cancel. I like to have them at good till cancel because let's say if I come home from work and when I go to work around 8 a.m., stock market's open. Right now, because of a time zone change in the mainland, stock market's going to close at 10 a.m., but I'm not getting home from work 10 a.m. It's going to close at 10 a.m. Hawaiian Standard Time. I'm not getting home from work sometimes until 6 p.m. Hawaiian Standard Time. So I want this open still. All right, even if I'm going to cancel it, I want to cancel it myself. If I leave it at day, it's going to disappear after 10 o'clock, and I won't be able to. It's easier for me to remember and check on what was going on. So switch it over to good till cancel. This is basically showing me I'm selling this, break-even prices, how much buying power it's taken, and I'm going to change this, which I put these in here. I like to have these different trades separated. I'm going to put this over in open orders. Send that off, and now that should be showing up right here under open orders. Now, if I get filled tomorrow, then I will click on this, and in the middle of here, it'll have a move to. And then I will move this open position, because right now it's just the open order. I'll move this, if it gets filled, it'll actually be an order, and I'll move that order over here under long stock. Now technically you could say, hey Brent, this isn't long stock, you're short one put option. That's correct. But on these option trades, none of these option trades are a position where I'm going to possibly take ownership of stock, right? These are just simple option trades that sometimes they're not simple, but they're simply option trades that at contract expiration date, I'm either going to make money or lose money. If I break even, I consider that making money, right? It's a win. But if I lose money, not good, right? So I want to keep those, I like to keep those separate. So I'll change that under the long stock. Just so you can see it, I right click there and they move to group. And then I'll just move this one over to that one. All right, so we see the nine days left, right? 9-day expiration. And look, there's some decent volume on this, and there's prices on here. So let's look at a different sector ETF. Let's take a look at how about industrials. Industrials had a pretty good drop. Let's see if we can get any premium at the 94. We'll take a quick look at the XLI for industrials. You see it's kind of been going sideways over the last 6 months. Rallied up right here, but it's kind of been going sideways. Now it's getting to the lower part of its trading range. Looks like around the $96 area. There's some support there. And we look at the year. Yeah, seems like around that $96 right here. Touched it before right here. Yeah, it seems like 96 has some support. Looking at the weekly over the last 5 years. See it more about 95-ish in there. Oh, okay. So let's look at 94. All right, let's take a look. Same contract period, 9 days left. 94. Oh, look at this. Look at this. Look at this big spread. Right? 23 cents, $4.95. Look at this. Wow, hardly any volume. Right? Hardly any volume. XLF had a lot of volume. Look at this, no pricing. All right, let's look at XLF again to compare. Lots of volume. Look at that. Lots of volume on XLF. Look at pricing. A lot of pricing in here. So what does that tell us about XLI? XLI is more difficult to do this on. There's just not as much demand. Because there's not as much demand, look at this. There's hardly any prices. We'll try it anyways. Let's see if we can get filled for 25 cents. That's the most this contract traded for. We'll try it anyways. 25 cents. Change this over to good till cancel. Right. Well, we're also going to change this put that into open orders. And let's pull up our calculator here and look at, if we get filled on this, what is our commitment? Our commitment is to buy 100 shares of XLI at $94 per share. All right, so this is what we're currently obligated to. We're currently obligated to 6,000. We're trying to get obligated for an extra 3,000. So let's look at everything together. If we get filled on this, $94 times 100 shares, you probably know what that is, 9,400, plus our 6,000 of open orders already, plus we're trying to get another 3,000, right? So we're looking at if this contract goes through, and if this XLF contract goes through, then just on selling cash secured put options, we need to be ready to come up with $18,400, right? And that part is really important, because let's say if we only had $1,000 in the account. Ooh, that's bad. That's naked, right? It's not covered up. It's not secured. It's unsecured. We're making legal promises into the market that we can't afford to keep. So let's just be mindful of that. And now, what did we learn today? Okay, we learned that some contracts, some underlying assets are a little bit harder to do this on because there's not a lot of volume, right? Look at this. There's just not a lot of volume in here. For some reason, this has a lot of volume that's trading. But look at this. Oh man, nobody wants to. There's no one, I guess, buying from retail investors. It's all just, you could buy it from the market maker or whoever is selling it, but that's it. There's nothing for you to sell, or not easily. Maybe that's the best way to say it. Not easily able to sell. But compared to XLF, look at this. It's still the same 9 days to expiration. Oh, look at that. Even on our 30, right? Look at the spread here. 5 cents to 7 cents. 10 cents to 14 cents. 17 cents to 23 cents. That's a heck of a lot better, even though that's not, as tight as like 1 penny. It's a lot tighter than this, 23 cents to $4.95. But generally, overall, if you're selling cash secured put options on stocks and underlying assets that you're happy to take ownership of, you don't really have to worry too much about this spread because you don't really plan on closing it out. But nonetheless, it's still good, right? It's still good in case something changes. So that's going to be it for today, where we put those orders in. We'll see what happens tomorrow. Keep you updated on those. And remember, we're just working with these particular ETFs just for educational purposes, training purposes. More than likely, there's a good chance you shouldn't be doing this in your own account with these particular underlying assets, but you can figure out which assets would be good for you to do it with by doing some research here, going through this playlist, getting those downloads, putting that information together. If you need some help with it, contact me. You guys have a fantastic day. Aloha.